you see informal segment customers in India, their entire family is involved in like income generation, and they've got like multiple income sources. So you don't have to underwrite a particular customer, you underwrite the entire family. When you see two kirana shop adjacent to each other, both income levels are never the same. Right? Or you see two medical shop adjacent to each other, the income levels are never the same. If there is a customer who is taking first time loan, you always have to think very conservatively about that customer, because these customers are very innocent. If you lend them conservatively at the first time, let them get matured in that journey, then of course those customers becomes your very good lifetime value given customers.
And what do you think will separate the successful NBFCs in the next 5-7 years from the ones that potentially either don't have the same rate of growth or fail?
So,
the rules of growth in Indian financial services are being rewritten. The old playbook of more branches, bigger cities, safe borrowers is no longer enough. What we're seeing is that institutions that are winning are building markets that the formal economy and the formal system is usually ignoring, and doing it with precision, empathy, and trust at scale. We have a very special guest who I'm very excited to talk with to discuss this and more. Someone who has spent over a decade advising some of the largest financial institutes across KPMG, Accenture, Deloitte, and Genpact, and then has built a digital architecture of an NBFC from scratch. Today, as Chief Growth Officer at SK Finance, he's leading one of India's most remarkable growth stories. Please welcome Mr. Girish. Thank you so much for joining us on this podcast.
so thank you so much, Paritosh, for having me here.
So Girish, I'll start with the most obvious. So you've taken SK Finance from sort of a 15 billion rupee to 100 billion rupee AUM in just 7 years. That's a remarkable story in itself. What I want to talk about is really the 10x growth that you've lived. How was it possible?
Well, see, first of all, I would like to start saying that I've been really lucky that throughout in my career, I've seen the growth multiple times. And there are a few examples, and then how we've used that in SK, we'll talk about that as well. So very beginning of my career, when I started my first job, that point in time, the BPO industry in India was just about to start, right? It was finding its identity globally. And a lot of people were seeing that what this industry can do. And I got an opportunity to participate in one of the largest BPO service provider of India and being part of the initial team of solution design. And that's where we build a lot of solutions from the scratch for many industries, for many processes. And that translated into a great growth story. When I joined that company, we only had a couple of thousand people. I left the company in about 3 years. And we ended up at that point in time with 16,000 people.
Oh, wow.
So I've seen that growth story where the book was written from the scratch at a very, very beginning of my career at the age of like 22, 23, right? So that actually gave me a lot of boost that, okay, it's all about first taking the courage, seeing the market, that what exactly market demands, and then building up the right solution and implementing it. Of course, some solutions, some experiments will fail, but when you do a lot of experiments on the ground, it gets successful. Another example was just before I joined SK, was with another digital service provider. That's where I've set up the consulting practice from the scratch. That company was very established, big company, but they didn't have a high-end consulting practice at that point in time. So there was a plan to start that high-end consulting practice. And I was one of the first hire in India in that team. And again, in 4 years, seen the journey that from almost zero high-end consulting revenue, we have built like 100 million consulting revenue over there.
Wow.
Right. So there are many examples, and even the clients where I work with in my consulting career, you talked about, I've seen many growth stories over there. So that gave me a lot of courage that when I see, I was in Jaipur when I was with my previous company, I've seen the financial services in Jaipur very, very closely. And one thing which was very, very sure in my mind that this industry is going to grow exponentially. The way the India story has been written, the way the demand was going on. And luckily, I got an opportunity to join SK Finance that point in time. And when I joined SK Finance, of course, the market was very, very positive. There are a lot of foundational steps in the company were very, very right. And then along with all the leadership team, we have built a lot of solutions from scratch. There are a lot of departments got created that point in time. And all of that story played really well. All the foundations started compounding, if I can say, right? Compounding interest is like eighth wonder of the world. So That has exactly happened over here, and we have seen the growth. When I joined, just before that, our AUM was like 1,500 crores. Last year, we have clocked our AUM more than 15,000 crores. So that's the story, along with all the leadership team we were able to build and put on the paper, right?
That's a phenomenal growth story, I think. And you know what I'm hearing is there were obviously the seeds of it were planted when you started your career very early on. You got the opportunity to see something big and something growing at that scale, right? But if I were to say narrow down a little bit, what are maybe one or two things you would say that, you know, this is what someone needs to sort of follow to say there's a perseverance of a certain set of things that happen that enable this kind of growth?
Yeah. So see, my philosophy was always to start with the process first, right? So what I've seen is whenever there are a lot of people who starts with, let's say, an end goal first or a technology first, right? And that's where it's hard to connect the dots during the journey, and a lot of experiments get failed, right? So my philosophy is always to draw down the process at first, right? Once you have the clarity on the process, right? You made your process map really well, you did the documentation really, you know what exactly where it starts and where it ends. And of course, that tells you that which persona in the entire workflow ecosystem plays what role. The handoffs are very, very clear. So the process, I think, is the first in my view. The second piece where I've learned, like in a very good way in my consulting career, is the adoption, right? Because the consulting is always like meant in a way that people come with a lot of papers, but actually it doesn't get implemented, right? But I've always tried that whatever design you do, it should get adopted, right? It's not just to end as an implementation, it should end at the adoption by the users. And that's where the real benefit comes in. So there has to be a right adoption strategy, which has to be laid out upfront. So you know how many users are going to get impacted with this transformation initiative or with this new initiative in the company and actually outside the company as well with your customer and partner ecosystem. And if you lay down that really, really well, the entire change management strategy before you start the project or the transformation story, I think that really works very well. So in my view, first is the process design, second is the adoption strategy, then select the right technology partner, and then start the implementation. The chances of success are very, very high after that, and you definitely enjoy that success, right?
No, I think that's a very interesting counterpoint, because typically I think it's the tendency is to jump into technology.
Yeah.
Oh, technology can solve the problem, and let's just put the greatest and greatest system in place, and you know somehow that will help growth. But I think what you're bringing out is sort of the fundamentals need to be first clear. So you have the baseline process, you know, who, what, like you said, I mean, simple thing like handoff and change management. I think that's always usually an afterthought.
Yeah.
Because you realize things are not working, and then you go, oh, I think it's because we didn't really bring everyone along in this journey. We just said technology will solve the problem.
Exactly. When you see like your first party in the process is aligned, second party says, oh, I don't know what to do, right? And that's where the breakages happen and the entire thing is down.
Yeah.
So if you design that upfront, you align them upfront in the story, and of course you've taken their inputs as well before you start the journey.
Absolutely.
That's where the success comes in.
So then they're sort of vested in the success of this.
Exactly. Exactly.
That's a very fantastic view, I think. So you went from being the chief digital officer to a chief growth officer, and at the same institution. You know, sort of what changed for you? And what did that transition tell you about how financial services should also think about sort of this digital transformation that they're on?
Yeah. So see, I'm a Baniya, right? And the business is in my blood. And that's where our forefathers have built that, and that continues here. So whatever I do, I think there's one thing in mind, is it should add value to the business. And this has started when I see like technology like about 15 years ago, that was largely meant to do, first is the infra-related work, second is implementing ERPs and doing customization on top of that. Then post that, there is a big transformation happened through SMAC, right? All of us know about it.
Right.
The social media got like exploded, the entire customer experience, life cycle has got changed. Then the mobility got exploded again, right? Everything which was only available to our web portals now started shifting towards the mobile, and doorstop services were being available. Analytics, of course, all of us seen that what kind of value it has made through the data-driven decisions. And then cloud, it has given scale to everyone.
Right.
So all these four things have happened. And apparently, in my view, what has happened is there is a shift there's a part of the technology to move towards the business. And that's where the digital evolution happened, right? So digital team was always like doing a midway work, taking the business requirement, understanding what business wants, and then getting things done by leveraging the technology available in the background. And that's the role which I played initially over here in the company by taking the role of Chief Digital Officer. That what exactly our different business function wants, both in our vehicle finance vertical, SME finance vertical, and other verticals as well, and how we can equip and enable them with the right technologies and new age technologies. And that has worked out really, really well, right? We were able to implement a lot of technologies, which has like helped us in terms of growth, opening up more branches, very easily hiring more people and getting productivity out of those people and getting the right customer satisfaction as well. Then COVID happened, right? And during the COVID, I started spending a lot more my time with the business enablement, that how we can use this time to generate a lot more business in the company. And that's where I started taking like a partial responsibility of some of the business functions as well. So we have built a lot of solutions for a couple of our business lines, started implementing those. And that has played out also really well. And we've seen a lot of growth in those business verticals as well. And there's a natural shift, right? That I started spending my time with technology as well as with the business as well. And that shift has also happened, I've seen in the market as well. Because coming from the consulting background, I see a lot of trends and a lot of prediction what is happening in the market, right? And I see those trends and prediction. Actually, digital was not like a support or a middle function. Digital is now becoming like a business. So there is no difference between digital and business.
Right.
And that's exactly the trend which I picked up. I say, why don't I now use all the knowledge which we have built up, all the data which we have built up in the company, and started leveraging that and generating more business for the company. And that's where I took the transition from a Chief Digital Officer role to a Chief Growth Officer role, that how we can generate more business for the company, leveraging the digital as a back-end expertise. So that's how this entire story has been built out.
It's interesting because I think what you said about digital, I think maybe the natural tendency is to think about digital as, it's the technology side of the business. But what you're saying is actually it's not the technology, it is the business.
It is the business,
right?
Yeah.
So you have to sort of shift your lens a little bit to say, if digital is the business, then I have to think of it like a business in terms of adoption, growth, customers, how do you source? I mean, all of that. I think everything becomes part of that story. That's a very different sort of view. And in hindsight now, I think it seems very natural that you would take that role and grow it.
Yeah.
So, one thing you talked about was obviously scale and how this business is growing. But the question is, a lot of customers don't have a financial footprint, especially if we would talk about tier 4, tier 5. I mean, almost the far reaches of India, who we're trying to also include in this whole financial sort of journey.
Yeah.
So how does one decide to lend to customers like this?
Yeah. So see, I think there are a lot of companies who are writing the stories on how best possible way to lend to the informal segment of customers in India. There are a lot of new innovation also continuously happening. The way I see this is in 3 different parts, right? When you see the customer who comes from the informal income segment background, the first one is the local intelligence. So the local intelligence is about the locality of the customer and about the customer as well. If somebody can get both of them put together, I think that gives a lot of data to underwrite the case. So let's first talk about the locality of the customer, right? Generally, that comes first by hiring the local staff by the company. So when you hire a person locally in your branch, that person actually comes with a lot of insights already.
Very interesting.
Right? So you already know that which area, which pockets are really doing good in that particular locality, and which pockets you generally has to avoid, like dominated areas and all, right? So that insight comes with the local team. Then there is a lot of insight comes in what kind of income sources the people have in that locality.
Okay.
So generally, when you see informal segment customers in India, their entire family is involved in like income generation, and they've got like multiple income sources. So you don't have to underwrite a particular customer, you underwrite the entire family, right? So you have to understand that what kind of agriculture income sources this person have, what kind of other income sources they have, what kind of core income sources that have, and typically what income sources generate what kind of income levels in that area. So that also comes from the local vicinity. The third piece is that there is a lot of areas where there is already a maturity in terms of partner ecosystem.
Okay.
So you have to understand that partner ecosystem as well, that what kind of partners which are already in place And when you meet and greet with those partners, you get a lot of insight that what kind of calls you can take in that area, what kind of calls you have to avoid in that area. And of course, if competition is present, then by meeting the competition, you get some insights there as well. And then the other piece is the local government support. Because typically when you are doing like a secured underwriting, there is a lot of local government department support required to either hypothecate the case or mortgage the case. So you have to understand that ecosystem as well, what is available in that area. Once that all documented, then you know that in this area where I can find my targeted customer and then can take the lending up business in that area. The second piece is the insight about the customers, right? So that typically comes when somebody goes and visit the customer, which typically we call personal discussions with the customer. During the personal discussion, you get a lot of data points. So first data points is that if they are running a shop, what kind of inventory they have.
Right.
Then everybody actually maintains some kind of record, like either manually or on some system. So you can understand that kacha record and understand what kind of purchases and sales that guy has, right? And then, of course, like another example I can give in India, like the way marriages happen. So still a lot of arranged marriages happen with the reference checks. Right? So you do reference check and you are like ready to marry, right? Same thing applies in the lending industry as well. So you can do a lot of reference check with the trade partners of the customer, with the neighbors of the customer, and during the reference you generally get very good inputs. And when you triangulate all these data put together, I think it gives enough insights about the customer and how to lend to that customer. The second interesting piece which comes over here is the conservative lending. So what in my view one should follow is that if there is a customer who is taking first time loan, then you always have to think very conservatively about that customer, because these customers are very innocent. And why I say innocent is they have not seen like a lot of money laying in their bank account in the past. So as soon as a lot of money comes, typically there are chances that money can be used at the place where it should not have been used.
Very interesting.
So if you lend them conservatively at the first time, let them get matured in their journey, then of course those customer becomes your very good lifetime value given customers. So that plays another important role. The third piece, which also my personal view, is the insurance. So when you give loan to these customers, typically the death ratio between an urban customer who has or a claim ratio between an urban customer versus the rural customer is typically high, right? So taking an insurance is very, very important, because is their lifetime the earning person who is get involved over here, and all those things are there. So that's very important, and taking an insurance of the asset is also very important. So I think if you do these things, these three things put together, which is the insights, which is about the conservative lending to begin with, and taking the right insurance coverage, it's not that tough to underwrite an informal segment customers.
That's very interesting, because I think, when you say this conservative lending, I think that's the first time I've heard the term in some sense, to say that even though as a business it makes sense to give more, you are advocating for actually sort of slowly educating the customer on fiscally being responsible with the money that they get. And that itself, it's the way I look at it is they're sort of building trust in this system, you're building trust with them, and then eventually they become a customer that, like you said, a lifetime value is much higher. NPAs are very low because they built that relationship.
True.
That's a very interesting way to look at it. I think, like I said, for me, it's the first time I've heard this. It's a lovely concept in itself that a business is looking at it and saying, yeah, I could do more. I mean, I could definitely give them double, and then I'm holding back because I want them to learn to be responsible. Now, let's switch. This is individuals. Let's say now there are MSMEs, right? I mean, there are 78 million odd MSMEs, and that's a great segment that I think everyone's saying growth is going to come from there. And so, but a lot of them don't have any sort of financial footprint, which is formal at least, and a lot of cash type of businesses. In this case, how do you learn? Again, are there some similarities in the way you lend to individuals? What's the model there that one should look at?
So see, of course, MSME growth story played a very, very vital role in the past in India's growth, and it's continued to going to play that role, right? But lending to MSME which doesn't have like a formal income footprints is another, I would say, a lot of data science required behind that. So first you have to collect the data and then you have to build science on top of that, right? So typically, let's say when you see two kirana shop adjacent to each other, both income levels are never the same, right? Or you see two medical shop adjacent to each other, the income levels are never the same, right? Because the way they put the inventory, the way they have interacted with the customer, the way the kind of experience they brings in is very different, and that translates into their income level, and then again translates into the kind of amount you can lend as a company to them. So first piece is, I think, go again, do the very deep personal discussions with them and collect those data points. So I think the first data points with MSMEs is checking about their inventory levels. So when you know what kind of inventory that person has, you automatically get an idea of what kind of sales they might be making on a per day or a per month level. So that's one thing. The second piece is about the experience. Because typically somebody who doesn't have the much experience and doesn't have come from that background, automatically they won't be able to make a lot of money out of this, or sometimes they actually close the shops as well and go. So experience plays a very, very important role. So for MSMEs, if somebody who has spent first 2-3 years already in the business, taken that experience already in the account, then of course chances of successful further journey will be very, very high.
Right.
So if you can underwrite that experience as well, that's another piece. The third piece is, of course, again, the trade reference I want to talk about again over here. Because reference plays a very, very important role. If you can take couple of trade reference from where they buy the goods, or maybe to whom they sell the goods if that's available, and if you talk to those people independently, and if you triangulate all these three data put together, right, you can actually estimate their income levels at a very, very accurate level. And from there on, the underwriting can happen to the MSMEs as well.
So it's interesting, because in both these sets, you said in a lot of on-ground, sort of knowing the customer, knowing their sort of relationships and the network. One question I have, which naturally sort of springs up, is how do you scale this? Because anytime it's a human-heavy sort of concept, how do you really scale this? Or is it a conscious choice to say what we can do is what we will do, and that's the way we will safely grow the business?
Yeah. So see, this is what, again, very early in my career through BPO industry, I've learned, right? Same question applies that when you go to a customer, let's say in US, and say, tomorrow this work will happen from India. They'll say, how can you do this? This is very complicated, right? My team is doing this work since last 15 years. How can a 23-year-old graduate guy do this in India? So the important piece is the decoupling. Right. So first thing you have to do is you have to decouple all the tasks which is required from first lead generation until the final payment to goes to the customer. There are certain tasks which has to be done at the branch level.
Okay.
There are certain tasks which can be done at the central level, right? Of course, when you lend to a customer which is informal segment, you cannot avoid the face-to-face interactions,
right, but
you can limit those tasks. So you can assign a particular, let's say, a personal discussion on FI checklist that I want to collect these data points while you go and meet the customer. I want to collect these kind of, let's say, a multimedia image or video about the customers, right? So a junior person can go and collect all these data points. So you don't need very senior guy to do that job.
Right.
And when you decouple that work, and when all these data points comes through your system, LOS system, to the backend, a senior guy, he can actually see and underwrite the case very, very easily. So the whole idea is that start decoupling all the activities, assign right person the right task, of course with the right cost, and then leverage the data for further underwriting. So that's how I think things can be built up.
Now, fair. And I think you mentioned video, and I think that's one I think push that we are also seeing, which is using video more, because video, it's sort of a little equivalent to meeting someone.
Yeah.
You can get a sense of the surroundings, the inventory, kind of the location, and that gives you enough intelligence, maybe, which sits on top of the other intelligence that you gather.
Yeah.
Now, obviously we talk about scale and growth, right? It comes with its own set of risks. And I think we've seen a few cases, obviously, where I think companies decided to just grow at all costs, right? And then what happens to the company, right? I think for thin file type of customer that we talked about, or these MSMEs which have a low footprint, how do you build a risk framework for customers like this to ensure that, to find that balance between growth and managing risk?
Yeah. So see, the risk framework which banks have put in will definitely not work as it is for these kind of customers. Right. There are a lot of customization required on that risk framework. The first one is, I would say, is the right pricing. So first, because you have to do a lot of like a doorstep service work for these kind of customers, which actually adds up to a lot of cost in the ecosystem. So you have to do a right price. So what is the most optimal price where even company can make some profit and it's not heavy for the customer as well. So getting the right price for every product and every ticket size is, I think, the most important piece, so that you can cover the risk around that. Right. The second one is, in my view, is getting the right team in place. Because the local team I talked about earlier as well, it actually plays a very, very important role. Okay. So once you have the right team at the right cost, that also manages your risk really, really well. The third one is about placing the branch at the right place. Because the customer is getting associated not for the onboarding journey, is getting associated for the entire loan life cycle, which stands for few years. So for few years, you have to be in touch with the customer, right? From a collections perspective, or maybe from a upsell, cross-sell perspective as well. So if branch is too far away from the customer location, that customer might not get served in a right way. Oh, interesting. So placing the branch at the right location and servicing the customer in the right vicinity, where our team can travel easily and can serve that customer, that plays a very, very important role from a risk perspective. The fourth one is, I think, I would say, is another very important piece, is the customer education. So these customer actually requires a lot of education upfront. So a lot of training actually goes to the employees, and that employees further train to the customer that now you are getting into a formal segment of lending. So you have to take care of all these things really well, so that it doesn't hamper your credit profile in a longer run. So I think when all these things we put together, and one more piece which I would like to say is the government ecosystem, because you have to either mortgage a property if you're doing a LAP loan with the customer, or you have to, let's say, do a hypothecation, you need a RTO full support for a vehicle financing business. So understand that ecosystem as well. So when you put all these together and tick all the boxes, I think risk can be managed in an appropriate way for these customers.
Right. No, I think a fair point, because I think that's been the, at least, what I've seen in the industry, that's been that sort of balancing act.
Yeah.
Because growth at all costs is sometimes the story, but I think there is, maybe what you're saying is, there is a way to grow at the right cost. It's almost like grow at the right cost and the right risk.
Yeah, absolutely.
And there is ways to it.
So this is a business of risk.
Yeah, exactly.
Right? So you can't avoid 100% risk, but you can actually optimize the risk.
Exactly. I think that's the right way, lens sort of to put on it. And maybe a little bit, if I were to ask you your perspective and in your approach to driving growth in India, in Bharat, right? Especially with all of these AI initiatives, digital initiatives, what do you think, in the lending sector, what's your approach if you were to sort of maybe...
Yeah, so see, that's a very interesting question, right? It's talked quite a lot, right? That how the lending industry will shape in the future as well, the way it's played a significant role in the past. So in my view, both secured and unsecured lending should grow in India to participate in the right way in the growth story. And both should have a right balance as well. Mm-hmm. So only, let's say, unsecured grows very, very rapidly. That might impact in the longer run. We have seen the MFI story a few years ago. So both has to be both has to grow, but both has to grow in a right proportion. Right. So that's first take. Let's say if we specifically talk about secured lending, of course that requires some physical presence, because you have to see the asset and you have to see the customer. Right, again, as I said earlier, decouple their work, whatever bare minimum required, put that in the branch. Rest, always do a digital first strategy, and that can grow very, very rapidly. Similarly, like fintechs are actually doing really well in terms of the unsecured lending these days in India. I think that story should continue. It will definitely continue. It's playing a vital role, especially for the customer who already have some sort of income proofs available, and digital underwriting is happening those customers. That should grow. But both should grow in a right proportion. That's my first take. The question which you asked on the AI, right? I think this is one of the best innovation I think happened in the mankind so far. That's what I learned it. So I've recently read a book called Supremacy. It tells the entire story, the way the entire AI got built, the way we are seeing it now, and what has happened 10 years ago, right? So that book has the entire story. So fascinating to read that book. And this is, I think, the best innovation, as I said. One has to reimagine, I think, the every workflow in the company now. And wherever they can best possible leverage AI, that should happen. Because one, that will give speed. So the customer always wants the speed. If somebody had decided to take loan today, they actually want the money in next 1 minute in their bank account.
Absolutely.
And that's what the lending industry has always struggled, especially on the secured lending side. So with AI, I think that's quite a lot possible. Not maybe 1 minute, but you can reduce your turnaround time very, very significantly. So for example, whatever documents were earlier checked by backend ops, now you can put a document AI which can verify the document then and there as soon as it gets uploaded at the customer location. Right? You have to touch base with the customer earlier with a lot of call center, both collections and sales perspective at the back end. Now your voice AI can do a lot of these work, right?
Absolutely.
Data, again, analysis takes a lot of time, but with data, you put AI on top of it, you can actually get a lot of insights very, very real time. I think if somebody use these three propositions in the lending industry really well, reimagine the journeys, it can actually contribute in a very, very significant way for growth of this industry, right?
Right. I think that's, AI by itself, I think people have maybe prescribed sort of magic to AI in some sense, I think sometimes. And I think to your point, if you think of AI, I think as a partner in the journey, but you have to think fundamentally AI, not I'll just plug in AI and some magic will happen. I think it's if you rethink your journeys and your business as an AI first business, then I think there's a lot of value.
See, as I said earlier, right? Process first.
Process first, yes.
Correct. So without that, if you start plugging in technologies,
exactly,
success could be there, but it could be less.
Yeah, the chances are, either way.
So reimagine the process, lay down the process first. This is how these are. Right now, I am doing 20 steps. Maybe 10 will get eliminated. 8 will be done by agents. Only 2 I need.
Now I'm going to touch upon a little bit, about distribution. I think that's possibly going to become a new moat in this ecosystem. I think you had an article you had written about sort of precision-led distribution and precision-led servicing becoming very critical for business. Maybe you can touch upon a little bit. What does that really mean on the ground? Maybe what it means first, and then what does it actually mean on the ground?
See, every new branch which a company opens, right? Generally, I'm talking about. There is about 18 months to 24 months it takes to get the right ROI. And if anybody which makes any mistake over there, which is actually not precise, then the profitability of the branch is actually, you are expanding it further. It might come much later than that, what you are expecting. So your distribution network, whatever strategies you're putting in or whatever new footprint a company wants to open up, the precision is very much required. So as I said earlier also, the first piece is to the decouple that what exactly you want a branch to do. Only the pieces which is required of face-to-face customer interactions, leave that pieces in the branch, rest everything do centralize, right? Once you identify that, then identify where your customers are available in the abundance. So see, customers who are looking for loan are available everywhere, but you have to identify particularly what customer the company is looking for. So where they are available, then identify that area. That precision is again required. The third piece is that where exactly you locate the branch and what is the distance between one branch to another branch, right? So all those requires a very deep science. And once all these things put together, then actually we can reduce the time for a branch to become a profitable.
Interesting.
Over here. Right. So I think that's what I meant, that a very, very deep precision required wherever you're opening a footprint. And that has to be coupled with the bureau data as well. So nowadays there are a lot of bureau data which is available at a pin code level. So now when you couple that data with your deep insights available in that particular locality, then I think it's very accurate that where to open the branch at what distance you open 2 branches so that you can accurately put up your team and generate better profits from that branch in a shorter period.
So here you're saying that you're looking at a lot of information to even first decide. I mean, obviously the baseline is, hey, you should be profitable ideally in 18 to 24 months. So sort of have that goal in mind and work backwards to say that, look, the way you will get it is obviously if the density of customers, if the touch points, if this location itself becomes a focal point for, let's say, an X radius, and you have the right kind of customers there as well. So there's a lot of intelligence that you're saying has to be used before a decision is made where you place that pin and you say, this is my branch.
Exactly.
And anything off there means essentially you have now taken longer.
You're delaying your money. Right. Yeah, right. Absolutely. Another piece which plays an important role is that whether you are opting a DSA model or a DST model. Right. So if you're opting a DSA model, then that ecosystem which is already available in that locality, that also plays a very, very important role in identifying that. And when you're in DST model, then you have to identify what things are talked about earlier. So that's how I think things has to play all put together, and then we can get the right profitability at the right time.
Yeah, that's very interesting. I think because tying it to profitability is the key.
Yeah,
I feel like because if sure, I can just open a branch wherever I think, it looks like a densely populated area might be a great place to open a branch. But I think if you think a little bit more deeper is what you're saying, then you can, it may not be there, but it may be adjacent to it, and that's maybe your best ROI.
Exactly. And then another piece over here is you have to keep revising it also. Right? So let me take an example of UP. There was a very different perception a few years ago about UP, right?
Absolutely.
Now it's changing.
Yes.
And changing like one by one. So there is a central UP which has changed. There is a East UP is changing. Now West UP is changing. So you have to keep revising your methodology because things are changing on the ground. So whatever you have done, let's say maybe 18 months ago or 24 months ago for a particular location, just revise it and say whether it makes sense
or not. No, I think that's another interesting, keep that sort of engine going.
Yeah.
Because that also means potentially newer business opportunity. I think
exactly.
Think of it that way.
Exactly. And for that, all of us come to office, right?
Exactly. Absolutely.
Yeah.
Now the traditional playbook always said more feet on the ground, means more reach, more customers. But I think as you described, is it now shifting a little bit to this smarter distribution model that is what you described a little bit?
See, I think, let me give another perspective on it. First, we already talked about is secured lending versus unsecured lending.
Right.
So secured lending definitely requires a branch presence in my, without that cannot happen. Then there is another view is that first time lending and onwards lending to the customer.
Okay.
Maybe a cross sell, upsell, repeat sell to that customer. So first time lending to secured definitely need a fleet on street to manage that entire ecosystem. Over there also there is another catch which I want to say is whether customer has already identified the need. So let's take an example of a vehicle loan, right? Where customer knows I want to buy the vehicle.
Right.
There, if you can do a right footprint at the, let's say, a dealership level, then you can again reduce your fleet on stream. But where customer has not identified the need yet, let's say an example of LAP, where a fleet on street has to go to the customer location, says, I can give you the loan, then customer thinks what I can do with this money.
Right.
Right. So on that kind of scenario, definitely fleet on street is required. But secured lending, where needs are already identified, you can actually reduce it to a certain extent. And unsecured lending, of course, with the right data set available, right technology adoption, which is happening across the India, and with, of course, the India stack support, right? We have seen that, all of us seen that story already. It can happen without fleet on street. So that's how I see this entire ecosystem playing together.
No, fantastic. I think with that, I'll ask you one last question on sort of the future, right? Let's do a little thinking about 5-7 years down the road. I think from your vantage point, because I think you've seen the growth story, you're in the trenches, you know how this whole business is going. What do you think will separate the successful NBFCs in the next 5-7 years from the ones that potentially either don't have the same rate of growth or fail?
So, let me answer this question a little bit of context, right? So I've attended a seminar last year where there were about 12 20 odd founders of recently established NBFCs, right? All of them had a great, like I would say, energy,
Right.
a lot of things they can do, right? I would say skills as well. When I spoke to them, like very, very deeply, one common problem which I've seen with all of them, which is availability of capital, right? So I think the first problem which like a successful NBFC of next 5 years has to solve is the capital availability. That's what I see a lot of players are struggling as of now. If somebody can solve that problem with the right equity partnership, with the right debt partnership, or maybe a co-lending partnership,
Right.
I think that's the problem which the leaders of the NBFC has to solve upfront, that they've got a right capital flowing, because without that, there's nothing. Right. The second piece is the cost. Whether you are doing a digital lending or you are doing a branch debt lending, the customer acquisition cost is actually on the higher side. So somebody who can manage the entire customer acquisition cost in the right way, both from a digital perspective as well as physical perspective, I think that will be the winner of the future. And third piece is getting the right customer experience, because nowadays every customer is demanding the experience.
Absolutely.
Right? From first touch point until they exit from the company, they want to feel wow. They want to feel privileged. Right? And so that's the duty of any like NBFC leader, to make that happen onto the ground. Somebody who can solve all these three problems put together, I think they will be very, very successful. And of course, as we talked earlier, AI can play a very, very important role in that. So leverage AI to the maximum extent possible. Do a lot of experiments with this, reimagine your process journeys. I think once all these things are there, the success is bound to come.
Absolutely. I think that's a very well put. I think I have one last question. I know I said last question, but I have one last question. For traditional NBFCs who've been successful or growing, how are they leveraging AI? What do you see is a way? Because what you've seen typically with any new technology, right? There's a lot of resistance to technology first. We don't know what it can do, what value it provides, there's a cost, all of that. Then there is, once there's realization there is, but then it seems like it's a very long process to adopt that technology. Now, in the day and age we are now with AI, it's not a matter of months also, it's a matter of weeks where things are changing and shifting and growing. What do you think is happening with traditional NBFCs and maybe financial institutions? And are they moving at the pace, do you see from where you sit?
See, I think I would say our traditional, or I would say small NBFC, I think that's what I heard from your question. They've got an opportunity right now.
I would say it's small and large, right?
Small and large both.
Large are now established.
Yeah.
They have a process in place. They're comfortable. They're doing well.
Mm-hmm.
Do they even look at that direction, or they go, no, we're doing well. We don't need to touch this?
No, I think everybody has to. That's what my take is. Because when I earlier said that it's the largest innovation humanity ever had, right? And somebody is not leveraging, it's like, I don't want to leverage electricity, right?
True.
So what will happen, right? You can imagine.
Yes.
So it has to be like that. So AI is become like a electricity of the future business. That's how I see next upcoming few quarters itself. So somebody has to just like start doing some experiments. I know the end-to-end process laid out on the AI technology is still not proven.
Yes.
Especially when you couple that with the compliances, there's another angle to it.
Absolutely.
Because it has to be compliant as well. So my suggestion to all the NBFC leaders would be that start doing small pilots. Of course, there has to be compliance.
Mm-hmm.
So compliance has to put first. Whatever is compliant, start doing those pilots. Learn about this technology. Once you learn, because the change and the newer innovation is very easy on it. You just have to write a prompt.
Absolutely.
Correct. So once you understand the way it works, you know how to leverage. And as soon as you get the compliant processes, compliant technology provider like associated with you, you can actually like do the wonders.
Yeah.
So that's how I see it. So start experimenting like today.
Exactly.
That's what my last sentence would be.
I can't echo that enough. I think time is now. It's not yesterday.
Yeah.
To start some of these smaller experiments to really see where you can derive value first. And then that also creates, I think, sort of trust in that technology to say, it can do it. Why not experiment more?
Exactly.
And that's how sort of it grows. Girish, thank you so much. This has been it's been enlightening for me. I've learned a couple of really new things which I didn't have a lens for. And of course, your experience in building a business at this scale. So thank you so much. I really appreciate you, and thank you for coming on our podcast.
Thank you so very much for having me here. Really appreciate it.
Our pleasure.
Thank you.
You.